You get the email. Pre-approved for a $500,000 mortgage. Your first reaction is relief. Your second is a little bit of pride because a bank just looked at your entire financial life and said, yes. And if you let yourself have a third reaction, it's the fun one, the one where you're already picking paint colors for a kitchen you don't technically own yet. Here's what nobody puts in that congratulations email. Pre-approved means the bank has decided you can probably pay them back over the next 30 years without defaulting. That is a math problem about risk to a lender. It is not the same math problem as can I afford to actually live in this house without my entire financial life turning into a monthly panic attack. So, how does someone go from a happy little email to being one broken water heater away from a breakdown? Because the mortgage payment on that pre-approval letter is maybe 60% of what actually leaves your account every month once the house is yours. The other 40% is the part your lender was never in the business of explaining to you, because their job ends the moment you sign. I'm going to walk you through the real math on a $500,000 home. The number that's supposedly the median home price in a lot of the country right now. Not to scare you off home ownership forever, just so you're the one deciding whether you can afford it, instead of a loan officer whose commission depends on you saying yes. Let's start with the number everyone actually talks about. At today's rates, a $500,000 home with 20% down means you're financing $400,000. At a 30-year fixed rate sitting around 6.5%, that loan alone runs you somewhere close to $2,550 a month in principal and interest. If that were the whole bill, this would be a very short video. It is not the whole bill. It's just the part that shows up in the mortgage calculator ads. First, property taxes. The national average sits around 1% of your home's value per year, though it swings hard by state from under 0.5% to well over 2%. On a $500,000 house, call it roughly $460 a month, folded straight into your payment whether you remembered to budget for it or not. Then homeowners insurance. And this is the one that's genuinely gotten ugly in the last few years. Premiums have climbed nationwide, and in places like Florida, Louisiana, or parts of California, some homeowners aren't just paying more. They're getting dropped by their carrier entirely and scrambling for whatever coverage will still take them. Even at a fairly normal national rate, you're looking at another $200 to $300 a month. Now, if you couldn't put 20% down, which is most first-time buyers, add private mortgage insurance on top of that. PMI exists purely to protect the bank. If you default, you get zero benefit from it personally, and depending on your down payment, it can run anywhere from a couple $100s a month to a few hundred more. And finally, the one-line item almost nobody budgets for until the roof actually leaks. Financial planners generally recommend saving around 1% of your home's value every single year for maintenance and repairs. On a $500,000 home, that's $5,000 a year, or roughly $417 a month, sitting in an account for the water heater, the roof, the furnace, the thing you didn't know houses did until it happened to yours. Add it up. Mortgage, taxes, insurance, and maintenance before you've spent a single dollar on furniture, and a 20% down buyer is realistically looking at somewhere around $3,650 a month just to keep the house standing and paid for. If you put down less than 20% with PMI added in, that number climbs closer to $4,200 to $4,300 a month. That's the kind of number that makes accountants cry, and they're not even the ones paying it. And that's before location does its own damage to the math. Run these same numbers in Texas and your property tax bite gets bigger while insurance stays moderate. Run them in Florida or Louisiana and insurance alone can eat what an entire mortgage payment costs somewhere else. The $500,000 price tag is national. The bill that shows up in your inbox is not, and it rarely moves in the direction you were hoping for. But this isn't just about your kitchen fantasy anymore. This is about a math problem the entire country is quietly failing at the same time. Lenders and financial planners generally use what's called the 28-36 rule. Your housing costs, the whole real number we just built, shouldn't eat more than 28% of your gross income if you want breathing room. Go past that and you're not broke on paper, you're just broke in real life, which is worse because nobody warns you it's coming. Run our $3,650 a month number through that 28% rule, and you need to be earning around $156,000 a year just to comfortably afford a $500,000 home with 20% down. Go with the lower down payment scenario, PMI included, and that climbs to somewhere between $180,000 and $187,000 a year. Now here's the actual median household income in this country, per the most recent census data. $83,730 a year? Call it $84,000 if you want a round number. I mean, sit with that for a second. The typical American household earns roughly half of what it actually takes to comfortably carry a $500,000 home. Not a mansion, not a stretch goal, the median home, the regular one. And to be clear, plenty of people at $84,000 a year absolutely get approved for that mortgage. That's the trap hiding inside the word approved. Lenders will go up to a 43% back-end debt to income ratio, sometimes higher with a strong enough credit profile. That's not them confirming you'll be fine. That's them confirming you technically won't default before they've sold your loan off to someone else. Those are two very different promises, and only one of them is actually about your life. So the gap isn't a you problem, it's a structural one. Home prices climbed for years while wages did not keep pace, and the math simply stopped working for the person earning a completely normal, respectable income. You didn't get worse at money, the house got more expensive than the paycheck could follow. A couple decades ago, the median home in this country cost roughly 3 times the median household income. Today, that ratio is closer to 5 or 6 times, depending on the market you're looking at. Salaries did not shrink to cause that gap. Home prices simply outran them year after year, while the advice stayed frozen in place. Buy what you can afford is still true. The number attached to afford just moved without telling anyone. If you're finding this kind of real number breakdown useful, hit subscribe, because I go through the actual math behind the money decisions that get marketed to us instead of explained to us every single week. All right, so here's where things get uncomfortable, because I want to talk about who benefits when that math doesn't add up, and you sign anyway. Your loan officer gets paid, generally, whether or not you can actually afford your life 5 years from now. Your real estate agent's commission is a percentage of the sale price, which means their incentive is quietly pointed toward the top of your budget, not the safe middle of it. Your insurance company will happily sell you a policy today and raise the premium significantly at renewal, because by then you're locked in and moving is expensive. Nobody in that entire chain of people smiling at your closing has a financial stake in whether you can still afford groceries 18 months from now. That's not a conspiracy. It's just incentives lining up in a way that isn't pointed at you. And it's exactly how people end up house poor, which is the specific miserable situation where you technically own a home and can barely breathe because of it. House poor looks like this. Your mortgage clears every month, technically, on time. But your emergency fund never gets past a few $100s because there's nothing left to put in it. One car repair, one unexpected medical bill, one slow month at work, and you're suddenly deciding between the electric bill and the mortgage. You bought the home you were told you could afford. You just weren't told by anyone whose job it was to actually protect you from that number. And this isn't a rare, unlucky situation. The Federal Reserve's own surveys have found that more than a third of adults in this country would struggle to cover a $400 emergency without borrowing or selling something. Stretch every dollar of your income into a mortgage, and you haven't just bought a house. You've volunteered yourself into that statistic on purpose. I'll be honest with you. I got closer to this than I like admitting. Years ago, I was 3 showings deep into a place that was, in hindsight, financially ambitious for what I was actually bringing home. And I had genuinely talked myself into, we'll figure it out as a financial strategy. A friend, not gently, pointed out that we'll figure it out is not a line item in a budget. I did not buy that house. I have never once regretted it. And this is exactly why the industry loves marketing terms like starter home, which quietly implies the home you can currently afford is temporary, a rung on a ladder, something to feel slightly embarrassed about while you climb toward the real one. Meanwhile, the same shows and the same feeds that romanticize the reveal at the end of a renovation never show you the family 3 years later, refinancing to cover a roof they didn't budget for. The system isn't rooting against you exactly. It's just not rooting for you either. Those are very different things, and only you can tell the difference from the inside of your own bank account. The same pressure that makes homeownership feel like the finish line of adulthood is the exact pressure that talks perfectly smart women into a monthly payment that doesn't fit their actual paycheck. Because here's the quiet subtext underneath the American dream. Renting past a certain age gets treated like you're behind, like everyone else got the memo about adulthood and you're still catching up. That framing has done more damage to people's actual finances than almost any single bad investment I can think of, because it convinces genuinely responsible people to override math they'd never ignore in any other part of their life. And for women specifically, that pressure rarely travels alone. It shows up bundled with the same timeline anxiety around relationships, kids, and every other. Shouldn't you have this figured out by now? Milestone Society loves to hand us on a schedule we never agreed to. Add, shouldn't you own a house yet, to that pile, and suddenly a genuinely smart person is signing for a payment that scares her, just to make one source of pressure go quiet. It will not stay quiet. It will just change addresses. So, let's say the real math on the median home in your area at your actual income doesn't work right now. That's not a personal failing. That's just the math being honest with you before the closing table does it less kindly. Continuing to rent while you aggressively save and invest the difference is not a consolation prize. Money that isn't locked into a down payment, PMI, and a maintenance fund can go into a retirement account or a brokerage account and actually compound, which a house you're white-knuckling every month cannot do for you in the same way. Renting with a growing investment account can genuinely leave you in a stronger position a decade from now than owning a home you could never comfortably afford. And if you do want to own, there's an option nobody puts on the vision board. A smaller home, an older home, a home in a less trendy zip code, one that actually fits comfortably inside that 28% number instead of stretching to touch it. That house will never trend on your social feed. It will also never be the reason you're lying awake doing math at 11 at night. There is no shame in any of this. Not in renting longer than your friends. Not in buying smaller than you technically qualify for. Not in waiting until the number on your paycheck and the number on the house actually agree with each other. The only actual shame is signing a 30-year commitment based on what a stranger at a bank decided you could survive, instead of what you know from the inside you can actually live with. Okay, so what do you actually do with all this before you're standing in a showing falling in love with crown molding? First, build the real number yourself before you ever talk to a lender. Mortgage plus taxes plus insurance plus that 1% maintenance rule. Divided by your gross annual income, if it's over 28%, that's not a maybe. That's your answer. Second, get an actual homeowner's insurance quote before you write an offer, not after. Agents rarely bring this up because it's not their line item to worry about. In high-risk states especially, that quote alone can rule a house out. Third, Ask your lender for the full monthly number, not just principal and interest. Lenders can legally advertise the lower number because it sounds better. Make them say the real one out loud. Taxes and insurance, and PMI included, before you get emotionally attached to a house. Fourth, stress test the number against one income disappearing for 3 months. Job loss, a leave of absence, a slow season if you're commission-based. If losing one income for a season means losing the house, that's not a home, that's a bet. Fifth, decide your walkaway number before you start touring homes, not during. Falling in love with a kitchen changes your math in real time, and it never changes it in your favor. Write the number down before the emotions show up to argue with it. And last, remember the 1% maintenance rule isn't optional. Just because the house looks new. New roofs still fail eventually. New water heaters still die on a random Tuesday. Fund that account from month 1, or fund it later at a much worse time, usually during an actual emergency. None of this requires a finance degree. It requires doing your own math before a stranger with a commission does it for you. So, back to that congratulations email. The bank will still tell you what you're approved for. That number was never going to change because it was never really about you to begin with. It was about the largest amount they could safely lend without you defaulting. And defaulting and thriving are not the same finish line. The real question was always the one nobody sends you an email about. Not what can I get approved for, but what number lets me keep my emergency fund, my retirement contributions, and my actual life intact. That's a number only you can run. And now, you actually know how to run it. If this saved you from doing the "we'll figure it out" math I almost did, subscribe, because I've got a lot more of these hidden number breakdowns coming. The ones the ads and the open houses conveniently leave out, and you deserve to know them before you're standing in escrow, not after.